Hi, I'm Elizabeth Gearhart. I'm here with Michael Rosenberg with Diversified Investment Strategies. Hi, Mike.
Hi, how are you today, Elizabeth?
Good. So what's so great about your company?
Oh, I think everything is great about our company. What we do is we help people grow their money, protect their money, and ultimately preserve it. And when I talk about preserving it, I'm talking about preserving it through tax strategies and preserving those assets so they could leave it to the next. They leave the next generation better off than they were when they came into this world.
Oh, that's awesome. So you have specific strategies you use. Who do you normally work with?
Business owners, for one, and high net worth individuals, as well as corporate executives and professionals.
And so do you let people spend any of their money?
we do, but you know, people need to budget, and people need to pay themselves first. You know, and we say, pay yourself first. We'll path the way to a better retirement and future.
That's a good strategy. So if I called you up and said, I want to meet with you to go over my portfolio, and I have maybe 401k here, and I have an income right now, and I have a house, and I have this, what's the first thing that we would do when we meet? And I assume you meet people over Zoom these days.
Yeah, that's true. The world has changed, right?
Yeah.
What we do, the first thing is tell me, forget about the numbers, okay? Forget about the numbers are what the numbers are. You know, you're coming to me with that 401k and that brokerage account, IRA, so on and so forth. But what are you trying to accomplish? You know, most people have no defined goal whatsoever. So if I said to you, not you per se, but if I said to somebody who just came in, what are you trying to accomplish? Well, I want to grow my money the best way I can. Well, that's not a goal. I want to know a specific goal, and I always like to call that to my clients, dream in color, okay? Not in black and white. So give you an example. I want to retire. Okay, that's kind of a black and white goal. Give me the color version. So you want to retire where? What does your retirement look like? How are you going to spend your days? How are you going to spend your months? How are you going to spend your summers? Where are you going to live? What kind of house is it going to be? What kind of car are you going to drive? Are you going to be charitable? Are you going to be taking care of children, helping grandchildren? So I want to know as much detail as possible about what they're trying to, not just have as much money as possible, but retire on what's possible.
That's a really good point. So my husband is always concerned about our retirement, and he's constantly doing the figures. You've talked to Richard, you know him a little.
Yes.
Doing the figures and redoing them, and those are the questions he's always asking. What are we going to want to have money for? What are we going to want to do? And then how much is that going to take? And then what yield can we expect on that in different investment portfolios, and et cetera, et cetera. It's hard to figure out. I mean, but it sounds like you have a strategy to try to get as close as you can to what people need.
That's correct. And a lot of people go at it all wrong, by the way. And they do it pretty much with good intention. Because the number one way people save for retirement is what?
401k.
401k, exactly. Chart that I put up, I'm looking at it right now, as a matter of fact. Tomorrow's tax day, so I guess this is kind of timely. 1913, that's when taxes were initiated in our country. Highest tax rate, 7%. 7%. And then we went to 15%. And then World War I came about. We went to like 75 and 80%. And the war ended, and we brought it back down to the 20s. All right. But World War II, we were as high as 94% taxation. And even 1952, 1953, we're at 92%. And we stayed in those 90s all the way till John F. Kennedy, a Democrat, not getting political, cut taxes. You don't really hear too much about, Democrats cutting taxes, but he cut taxes. And it went down to 70%. And then Ronald Reagan cut to, I guess it was in 86, the Tax Act of 86, which is a real biggie. We went from 50% to 28%, and now we're living in a 37% tax rate. My point of that whole exercise is when I meet with a client, if you think taxes are going up or taxes are going down, knowing what you know about the world and all the borrowing that our country is spending, and all the money they're giving away.
I would say they're going to have to go up, right?
Yeah, you have to. I just had a Zoom meeting with somebody earlier, and this fella's putting $250,000. He's deferring of his income. He's deferring it, meaning he's kicking the can. He was 50. He was kicking that can down the road. And I said, if I gave you $100,000 today, I said, you know what? We're a very unique investment firm where we give you the money. So we're going to put $100,000 away towards your retirement. And you're 50. When you come in at age 60, we'll determine what terms of the payback will be. Would you take that deal? Nobody ever says, yeah, I'll take that. Why? Because they don't know what the terms are. They don't know that I'm not going to charge them 50% interest on their money. So I see so many people putting money away. It's just like interest rates today, mortgages and refinances are just hot right now. We bought a new home last year, and mortgage broker called up already on the year anniversary and say, congratulations, been there a year, and I've got some good news for you. The interest rate dropped just in that 1 year that it pays to refinance. And, it almost like you said to yourself, I think the interest rate is in a very, very low threes for 30-year fixed rate mortgage. And you say to yourself, with interest rates so low, would I ever want to go into a variable rate mortgage right now? No.
Oh.
Lock in that rate. And the same holds true. So what my story really is, in a nutshell, Elizabeth, is have different buckets. Don't put all your eggs in one basket, which is kind of a cliche when you're investing, but it's also a cliche. I use it from have different sources of income that have different types of taxation.
Right.
And most people just have one. So if you have your brokerage account, that might be taxed at capital gains rate, which is lower than ordinary income rates. You have your IRAs, your 401ks, which are going to be taxed at ordinary tax rates. And then you should have some tax-free bucket, a tax-free bucket. And there's vehicles out there most people aren't aware of where you can invest the money just like you would invest and have.
So, right. So I've heard you either pay taxes at the front end when you put your money in, so you pay taxes on it and then you invest it somewhere, or if you put it in tax-free like a 401k, then you pay.
No, that's tax deferred.
Yeah, so that's what you mean by deferred. So a lot of us have money in 401k, some in.
Right.
You're saying right now, maybe pay taxes on it now because you don't know what the tax rate is going to be in 10 years when you might want to take it out. And then you don't pay tax when you take it out, right?
Yes, that's true. But there's certain vehicles that are available to people, okay? Certain people, not everybody. To get the really good type of, and it basically it's called corporate-owned life insurance. Corporate-owned life insurance is very, very low cost, but really it kind of mimics your investment cost. Always liquid, no taxes while it grows, and you pull it out tax-free.
Well, that sounds like a good deal. Do you have to be in a corporation to get that?
No, you have to meet certain criteria in order to get it, but it is available. People aren't aware of that.
Yeah, Richard's going to have to talk to you about that.
Yeah, somebody like him, he's self-employed, good income, he would qualify for it. But, you know, I've got people, that's what we're doing. You and I had discussed, you know, I do a lot of work with athletes.
Mm-hmm.
And that's what we do with them. You know, these young fellas are making $1 million, $2 million, $5 million a year, but their earnings are not going to be long-term. And they need income between when they retire, let's say at 32 and 65, when their pension comes in, the dean. So this, what I'm talking to you about, you could tap that at any time and not pay any penalties for early distribution before 59 and a half.
Wow, that's a really good deal.
Yeah, it's something that we utilize and kind of makes our practice. You know, if you were going to ask me the question, what makes you unique and different? And this is what it is. And that's why a lot of these high profile athletes are attracted to our firm. It's something a lot of people don't offer.
Yeah, I'd never heard of that before either.
Most people have it.
Yeah. So would you put all their money in there, or you had said earlier?
No, I wouldn't put all their money in there. But, you know, I always say, okay, take the deduction. Take the deduction, you know, so, you know, let's just say somebody's making $250,000 a year. So put your 20 some odd thousand dollars into your 401k plan. Got a match or go up into the match. And let's suppose you're saving $40,000, $50,000 outside of your 401k. Put that in here. Okay. Because it's just going to be like money going into a brokerage account. Right. Except you're not going to pay any taxes, always available. Pretty much the same investments are available inside of that that's inside the brokerage account. Only difference is you pull it, it's tax-free.
Right. And so we assume too that the stock market is always going to go up. I mean, it'll bounce around. It'll have its corrections, shall we say, but it will be in 10 years, unless there's a major event again, it'll be higher than it is right now. Right?
As long as we don't have 2000 to 2010. The market didn't go up for that. But yeah, you're correct. The market always goes up, even over a 5-year period of time. It's like a 98% probability of the market going up over 5 years.
Right. So even if you're 30 years old and you want to put a chunk of money in there now, and let's say you want to start a business when you're 40 and you want to take some out, there should be more in there, hopefully.
Yes. Pull it out totally tax-free.
And then you take it out tax-free and you start your business or do whatever you want with it.
We have used it for colleges, college planning. That 30-year-old puts money into this, and 15 to 20 years later starts taking it out over a 4-year period of time. Lets it grow again, and then uses it for tax-free retirement.
So is there a limit to how much you can put in there?
No. See, the limit, if you want me to get real technical on you, which you probably don't, but I will. Okay. This comes under the IRS code 7202, which most people aren't familiar with. And it's IRS code 7202. And what it basically says is if you buy $1 million of life insurance, okay, there's the term cost of that. And let's suppose the term cost is $500. Okay? So you're going to pay that term cost. And then the 7202 sets a limit of how much that you can go over and above that $500 before it becomes, you lose your tax advantage status.
I see.
So let's suppose it's $9,500, just to use a fictitious example. So you would put $10,000 in, $500 would go to just kind of cover that insurance premium. The rest of that $9,500 is invested totally tax-free. Now, if you went in and put if you went in and you put $10,001, totally loses the tax status.
Wow. So a person shouldn't really do this on their own. They should.
You can't do it on your own.
No.
You can't. And what basically happens is you don't buy it for the insurance aspect of it. You follow me?
Mm-hmm.
So you're going to say, I'm going to put $50,000 in. We set $50,000 what the minimum insurance would be, and we maximize up to the 7202 guideline.
Wow. Those are great tricks for people that really know how to handle money that the rest of us are totally unaware of.
Yeah, I mean, I come across a lot of people, very astute investors, and I try, and it's like, why are you different? And it is true, like what you had alluded to earlier, the stock market always goes up. So you could have a 10-year-old manage your money and put it in an S&P 500 fund or some deal like that. You'll be fine. Where we are different is we strategize, save you the taxes. I mean, think about it, even if we go back to the pre-Reagan days, and taxes go up to 50%.
Mm-hmm.
Wasn't that a great deal?
Yeah.
Right?
Yeah.
That was a great deal. So it's about when you retire, it's not what the income is going to be, it's what you keep. And really the variable is, besides the rate of return, which we could pretty much pinpoint the rate of return, but the real variable is how much money are you going to keep? Mm-hmm. So you and Richard have a goal that you want to retire on X. Mm-hmm. You might hit X, right? You might hit X, but 20 years from now, some Looney Tune might be in the White House and the Congress and the Senate, and they increase taxes to 90%. How was your retirement plan?
Well, they already hit us, quite honestly, in 2016 when they changed the tax code and they took away most of the deduction for houses and for taxes and interest on houses in New Jersey, well, everywhere across the nation, but it hit those of us.
It hit us hard in New Jersey to a certain extent, yes.
They targeted New Jersey, so yes, we have endured that. So,
yeah, we have endured it, but we're nowhere near, that 92% it was in 1952.
Yeah.
Okay. I mean that's a high tax. I'm looking at 94% and 44 and 45 were the highest tax. So think about making $100,000. You keep $6,000.
Well, it could happen. We're going to have to pay for this deficit at some point.
That's exactly what I say. Who's going to pay for it? And it's going to be through your retirement. So people better start strategizing today and set up buckets of money that are not going to be vulnerable to the government. Because, by the way, it doesn't matter Republican, Democrat. I'm not political. It doesn't matter. You hit it best. Republicans are in control and you saw tax increases. So yeah. Neither party discriminates as far as taking money away from us.
No, but the other piece too, besides just the taxes, is the interest rates. So you have to, if you have savings accounts or whatever you're using that depend on the interest rates, depend on you getting your money from interest, then when the interest rates are low, that's going to be tough too, right?
Well, no. Okay. Because we always recommend that even if somebody is an 80-year-old client of ours, they're going to have a portion of their assets in some sort of. You got to realize we are in a very, very low interest rate environment today. So, if you're an 80-year-old, we might have 40%, 30% of your funds in equities, kind of offset that low interest rate environment. Okay. And people also need to understand what kind of withdrawal rate you're going to have. And it's also, I have a strategy here right on my desk. I see I'm doing it with somebody, and they have some great strategies in where, again, not to get real technical, but they have it's called Monte Carlo simulation, which we basically can simulate your portfolio and tell you what the probability of you having money at the end of the road. It's 30 years, retiring at 65. And we have one investment in order to safe. Because what happens when you're withdrawing money, what's really important is the volatility. Volatility is the killer when you're withdrawing money. All right. And there's some strategies that take a tactical approach. So when, in this specific strategy I'm talking about, when the market came roaring down back in March, right, this particular company took our clients out of the market, minimized the downside, waited before it was safe to go back in. Right? So those folks are out for this year. So there are strategies to kind of reduce risk in and still be invested in the markets.
Well, this sounds wonderful. So are you taking new clients now?
We are. We're always welcoming new clients. Always. Well, we just put on 2 new advisors here at Diversified Investment Strategies, and we're always seeking out new clients. And consultations are free. People can contact me either online or call me.
Is there a bottom threshold to the amount of wealth they should have to work with you? Do you take people that have under $1 million in assets, or?
We do. We do take clients. You know, I mean, somebody has $100,000, we might put them onto a junior advisor. But for the sake of this conversation, we look at $250,000.
Okay. Okay, great. So that's wonderful to know. And that's where you really need to start sheltering your taxes and doing all these strategies. And anything else?
No, I would say I probably said more than I should, but I really appreciate it having me on, Elizabeth. It's really
great.
Pleasure.
It was fun talking.
Yes, I appreciate it. Thank you.
Thanks.